Hello, and welcome to our webcast. I'm Amy Pendergrass with Moss Adams, and I'm going to get us started for today's session, Innovating Your Back Office, Cash Management, and KPIs. Before we begin, I'm going to play a brief video.
Welcome, and thanks for joining us. We're pleased to present another in our ongoing series of continuing professional education webcasts to help companies and individuals conquer challenges as they plan for what's next. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget to the right of the slide view. You can ask our presenter questions during the webcast by typing a question in the Q&A window below the slide view and clicking submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions, which we'll ask throughout today's presentation. To respond to a poll, click the button next to your answer. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget to open a PDF file that you can save to your computer. Don't worry if you can't download your PDF certificate today. We'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. The attendance sheet is available in the slide deck and handouts widget. Please have all group members sign it and send only 1 sheet per group. Also note that CPE credit can be awarded only to participants registered as themselves and isn't available to participants who view the on-demand version. As a reminder, the presentation you're about to see isn't legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
And now I would like to introduce today's host, Elaine Irvin, Partner and Construction National Practice Leader at Moss Adams. Elaine?
Wonderful. Thank you so much, and welcome everyone to our presentation today. You know, we're closing out 2020, probably much to everyone's relief. It's been quite a tumultuous year for sure. But I think one of the things that reinforced was the importance of making sure that you have solid cash management, that your budgeting process is robust, and that you're really monitoring your KPIs as you continue to go through these uncertain times and make sure that you've got cash liquidity to make sure that you can continue to do so. And so I'm really pleased today to introduce our presenters. Kevin Jacobs is a Senior Manager with Moss Adams, and Aaron McFarland is also a Senior Financial Advisor with our Wealth Management group here at Moss Adams. And then, of course, Eric Newton, who is the Director of Construction at Prophix Software. And so with that, I'm going to turn it over to Kevin. And Kevin, take it away from here.
All right. Well, thank you very much, Elaine. I know I can speak for Aaron and Eric that we're all excited to be here and excited to present on this topic. To get things started, we thought we'd start off with a poll. Here we go.
All right. Thank you. So our first polling question is, how often does your organization forecast cash flows? A, monthly, B, quarterly, C, annually, D, never, or E, I don't know, or NA. And we'll give you a few moments to respond. To participate, please click the button next to the answer you choose and hit submit.
And I think as everyone's filling this out, personally, I hope we don't see a lot of D's, but maybe we will. I kind of doubt it. But one question that goes hand in hand with this is, how aligned is your company's cash forecast or cash projection process with the strategic goals of the company? And when I mean strategic goals, I mean when the company looks out 5 years, 10 years, or maybe even just 6 months or 12 months, what does the future hold? Elaine already touched on 2020 is an uncertain time frame. And so maybe it's an unknown, but how intertwined are those two processes?
All right, and it looks like most everyone has responded. So here are the results.
All right. That's great. I think that's kind of what it looks like most respondents, 80% are doing it at least annually, and 75 are doing cash forecasting on a at least quarterly basis. So I think we have a group of attendees who has a good handle on their cash management process and understands the importance. So that's good to know. As I was saying, knowing the strategic plans, or not necessarily knowing, but forecasting it out and knowing the impact of those plans on the company's cash flow, I think it is a key part to this process. Clearly, the cash flow needs at different times of a company's life cycle are different, right? At startup, a company's cash flow needs are different than they are hopefully 2 to 3 years in, when a company is hopefully financing its own operations with cash that's generated from the construction contracts that they're working on. You know, another piece to consider is exit strategy. When owners seek to exit a business, how are they seeking to do that? Is it through a sale to a third party? If that's the case, maybe there's not a lot of cash flow needs, but oftentimes in construction entities, especially in the small, not small, but in the closely held and family-owned businesses that we often work with, we see a lot of internal transitions. So how are those internal transitions being financed? Is it internally financed? Is the company providing notes to the new owners? How is the existing owner going to be paid out? There's a lot of things to consider, and being able to kind of forecast that out and align the company's projected cash flows with the future strategic plans of the companies is very helpful as companies start to think about strategic plans and goals. When we think about cash and cash flow and liquidity management, we think about really three things. The first is exactly what I was just talking about there, aligning cash management and the optimization of cash flow with the organizational goals. And I think a big part of that is tax planning. As I said, a lot of the construction companies that I work with tend to be closely held and family-owned, and those tend to be flow-through entities. So how, from a tax planning perspective, how are tax payments being made? Is the company making distributions for the owners? Another aspect to consider in cash budgeting and forecasting. The second would be proper management of liquidity through a defined decision-making process. And Aaron's going to dive into this a little bit more right after me, but this kind of gets into the fact that we know cash ebbs and flows over time, but how do we create a strategy to stick to as changes occur? And then lastly, we think about monitoring and reporting. How are we doing that? And I think the slide up on the screen here talks about the importance of cash and monitoring. You know, when I think about the ultimate purpose of a business, is to generate cash. Sure, you can also say that a company is in business to generate a profit, and you would expect them to go hand in hand, but that's not often the case. As I was preparing for this presentation, I thought of a story from college that I thought was applicable here. It was 15 to 20 years ago, and I was finishing up economics right before the year ended, and the professor asked the class, he said, "What does everyone hope to do when they graduate?" And somebody raised their hand and said, "I hope to get a good job and make a lot of money." And he kind of laughed, and everybody wondered what was going on, but he laughed and he said, I congratulate you on the first, getting a good job, but if you're making a lot of money, he said you're a criminal. Clearly it's a play on words. You should be hoping to earn a lot of money. And as I thought of this, and the ultimate purpose of a business is to generate cash, that's the goal. It's not to make or earn a profit, although, like I said, the two often go hand in hand. I think as I thought about that story, it kind of drove home that idea for me. I mean, cash is a key indicator of the health of the organization. If the company's sitting in a healthy cash position, it allows for a lot more planning and a lot more opportunities for the company. Ratios and KPIs are a great way to track how the company is doing, not only against its budget, but against competitors like-minded or similar companies. Eric's going to dive into this in more detail, so I'm not going to cover it a lot right now, but benchmarking is a great way to track your company's results and your company's operations year over year against those competitors. The CFMA puts out a benchmarking study every year. Moss Adams just put out our benchmarking study. It's available on mossadams.com if anyone's interested in getting it, but we really encourage all of our clients to do that. As you look at cash management and optimizing cash management, trends are important. Decreasing cash and increasing AR and underbillings, they tend to go hand in hand. What's driving that? We'll get into that in a few slides here, but then maximize short-term borrowings tends to go with decreasing cash and increasing AR, and then fixed asset acquisitions. How is the company historically acquired fixed assets? We see different practices kind of across the board on that, acquiring fixed assets through operational cash flows or acquiring long-term assets, fixed assets, through long-term debt. So proper cash management and optimization, it provides cash that fuels growth and protects organizations. On the screen, on the slide here, we have just a few examples. Obviously, cash management and optimization provides for financing of significant bidding and startup costs, new equipment acquisitions. They play a key role in debt covenants and surety relationships. We have up here just kind of a side note that unrealistic growth is the #1 reason for surety claims. So as you're budgeting, the takeaway being, is your budget realistic? Is it tied down to jobs that have been awarded, jobs that have been bid on, and we have noticed that we're likely to get the award, or is it more based on this is what we hope to achieve? So we talked some about cash management and optimizing cash flow. As I'm an auditor by trade, so where do I see the clients who I work with in the construction industry? Where are their pain points and where do they spend a lot of their time? And up on the screen here are a handful of examples. I'll run through some of them, not all. I think some of them are pretty straightforward, but on the underbillings front, what's causing them? Understanding really why they're there. Is it just really strictly timing related? Is it a schedule of values that doesn't allow you to bill until a line item is done and you're nearly there but not quite? Or is it at the end of a job and the job's underbilled because there's claimed or unprocessed or pending change orders? How active is management and project management in making sure that change orders are on track and being monitored and notices provided and communication lines are open between the general contractor, the owner, the subcontractor? All very important to consider. Idle or underutilized equipment. One question I like to ask during an audit is, especially for a lot of our clients who have a lot of yellow iron equipment, is when's the last time you inventoried your equipment? Are you using all of your equipment? What was the results of that inventory? And then secondly, when's the last time you looked at your market equipment, your equipment rates, and compared them to market? have you been using the same rates for years on end, or is it something that you're modifying on a job-to-job basis, on an annual basis, on a quarterly basis? The market's changing rapidly, and so if you have internally developed overhead rates and internally developed equipment rates, making sure that they're changing at the same time is crucial. Accounts receivable and retentions, one thing I just wanted to touch on there was just, if retentions, we see a lot of public works jobs, retentions can kind of hang up and drag on. Looking at the cost versus benefit of, does it make sense to try and bond around retention? Inventory-wise, are you buying to stock or are you buying for specific jobs? And accelerated debt amortization, rates continue to be at or close to an all-time low. So if you're prepaying debt or accelerating those debt payments, is that in the best needs of the company from a cash perspective? And I said I'm an auditor, and when I think about protecting cash, I first go to internal controls. And internal controls really starts with an effective policy and procedures. And internal controls from a cash perspective, I view them as internal and external. Some of the internal controls that come to mind, and they're really pretty straightforward, is just who's signing checks, where is the blank check stock kept, is there any requirement for dual check signers, is there, when check signers do sign, are they reviewing invoices or supporting documentation with the checks, or is a check or the signature stamp just being used? From an internal control perspective, we have up here bank-related controls, but with all the activity and all the payments that tend to be made via wire and ACH these days, how does your bank help you manage that process? And I say that because is one person able to initiate and authorize a wire to go out without a second set of eyes looking at it? Or does the company not have a policy that requires two people? We're seeing fraud in the industry and across all of the industries of third parties contacting the companies that we work with saying, hey, I just got an email from your CEO and this is for a new equipment software, and the emails look legit. More often than not, clients are well aware of what's going on, and their internal control policy is to verbally confirm before any wires go out, especially if it's at the request of the CFO or CEO. But a minor one that tends to be caught quickly is payroll fraud. And by payroll fraud in this instance, I mean third parties contacting payroll departments saying, hey, this is Kevin Jacobs calling. I would like to change my direct deposit information to the following. And the payroll departments make said change, and when payroll is processed the next go-around, I don't get my paycheck. So it's a quick hit for the person perpetrating the fraud. It's an external fraud, obviously, but it's a fraud that could have been avoided if the company had a different set of internal controls in place. And lastly on here is investments, and this is where I'm going to hand the ball over to Aaron, but investments are a spot where companies, if they have, like we talked about at first, kind of a defined decision-making process, investments can be a great spot to protect cash and have a strategy to help that cash grow over time. So Aaron, I'll hand things off to you now.
Thanks, Kevin, and good morning, everyone. I think a big part of effective cash management is really lifting up the hood and looking objectively at your existing decision-making process for your cash on hand. And that process typically, resides within the treasury function of a company. So I thought a good place to start here might be with a more formal definition of that function. And so we think an effective treasury function includes smart and strategic management of your cash flow, and excess liquidity. And obviously, we'll expand on some of the key operational issues of the treasury function today. But I also think we want to look at kind of how this is done at the larger institutions or public companies, as there's a lot we can learn from them. And for me, Amazon, Apple, Microsoft come to mind, probably because the news has highlighted their, success through this pandemic. But they may have 100 to 200 analysts looking at their cash daily. They may craft some super elaborate investment policy statement, chopping up that liquidity into finite buckets. And the recognition, is that small and middle market companies certainly don't have the horsepower to allocate these kinds of resources to this area. But, you can really take some best practices from those highly successful companies and employ them in private practice. The main theme you see a lot with these companies in this area is they structure their liquidity in a way that aligns with their longer-term vision. But they're extremely mindful of the needs along the way. And they do this by investing mainly in cash instruments and, to a large extent, into the public debt markets. Their key goal here is to maintain a high level of capital preservation and collect an income stream along the way. And really, this is why the public debt markets are so large, and why they're larger than equity markets. So this is the way we think about value held in a company. And what you see here is dollars on the vertical axis and time on the horizontal axis. So we're looking at kind of the variable growth of different areas of a company over time. And you'll see four main buckets here: goodwill, fixed assets, working capital, and liquidity. We often see companies spending a significant amount of time thinking about human capital, fixed assets, branding, new projects, and really activities tied to those. But we don't always see some of the privately held companies focusing on the synergy between working capital and liquidity. And that's really what we're zeroing in on today. So when we look at this specific area of value or synergy in a company, kind of first and foremost, we recommend they go through a 5-step process to determine the best way to optimize what you have in place. And I think it's important to understand that this process we're about to discuss is really a longer-term process that you put in place as we go through rate changes, economic cycles, seasonality, et cetera. And so the first step here is take a look at your current exposure. What marketable securities do you have on hand, and what's the status of the liquidity, maturities, and titling of those assets? This could be super easy. Maybe you just hold cash, or maybe you have, several laddered CDs because you're in a CDARS program. Sometimes we see a couple municipal bonds because the owner really likes, a revenue project, or maybe even some random stocks held. But this process is really all about looking at the collection of those assets and evaluating your overall level of exposure in each of the different risk areas, which we'll touch on in a second. So this graph, this is where it gets a little more interesting as we start to look at the business cycle. And I'd like to maybe burn this graph into your head a little bit. So what we have here is weighted average dollars on the vertical axis. That's just cash on hand. And then we have time on the horizontal axis. So this looks at months over a couple years, although you could certainly extend it longer if you wanted. And you can kind of see how, your cash has moved along the curve, and you could probably tell a pretty good story. You could describe why you had this dip or why you purchased this type of capital equipment. Maybe you had to make some shareholder payments. Could be a number of things going on over that cycle. But what we can start to parcel out at this point is maybe where some of our buckets lie and how we could put our cash to use. We like 3 buckets. We think 3 buckets make sense for a lot of different companies out there. particularly contractors. And so what we see, typically is there's a near-term bucket. You're likely dipping into this more frequently. The second bucket is strategic reserves, what we call strategic reserves, and maybe you dip in here once or twice over that cycle. The third bucket is idle cash, and this is really cash that remains in cash for that economic cycle. And of course, you would love to forecast this perfectly, right? But looking at this data really gives us information as to where our general buckets lie. So the next step here, kind of obvious, just extending that line into the future by getting out our crystal ball. And certainly challenging, no question, especially right now. But I think, you could make some really reasonable assumptions based on a few areas. Projects or capital needs in the future. What use of leverage do you want or need? Obviously, in the low rate environment, there's some opportunities there. Seasonality, budgeting, scheduling. And once you kind of do this looking forward, this just gives us another data point to work with. And so what we have now is, what do I have on hand? Where have I been, and where do I think I'm going? So the last step in this process that doesn't involve ownership at this point is addressing those third parties. And I can't underscore this enough. I think it's really, really critical to be proactive with your third parties and communicate upfront and be very open with them. I know Elaine and Kevin preach this from a business assurance lens as well. And obviously the first part of it is, what do my existing covenants look like? And if I were to restructure my liquidity, how would that affect my third parties? We see a host of stories here, both good and bad. And mainly the question that comes up is, if my cash position has changed in a material way, perhaps because I sold a large piece of equipment, do my past underwriting standards still apply, and how should I treat that cash moving forward? And this is really where, we've seen some good results when companies are very proactive about talking to their third parties about their long-term vision and how they want to implement maybe that cash. So the final step in the process is to address ownership's tolerance for risk. And this certainly doesn't apply to everyone, but it addresses those in the closely held or family-owned space, where there is a strong link between the corporate balance sheet and the personal balance sheet. And we often need to spend time here addressing the soft side of investing. And that drives the analytical people nuts for sure, but it's really critical. How do the owners feel about investing in capital markets? Also, how can the owners look to diversify against other risks on the personal side? That's critical as well, and it's really a holistic approach that's a big part of this conversation. But, at the end of the day, going through that 5-step process, I think gives us really good data to then start to put together a robust strategy within the framework of an investment policy statement. So with that, I'll quickly turn it over to Amy for our second polling question.
All right, thank you. So the second question is, does your company have an investment policy in place? A, yes, B, no, or C, I don't know, or NA. And if you would like to receive CPE credit for today's webcast, you will need to respond to at least 3 of the 4 polling questions. Also, just a reminder to submit any questions for the presenters in the Q&A window. If we don't have time to respond during the webcast, we will do our best to follow up with you afterwards.
So, Erin, we do have one question that's in that was submitted, and whether you or maybe Kevin want to answer it, but it says, my company's contracts are typically short, 3 to 4 months, and future revenue is very difficult to predict. Does this have a significant impact when evaluating cash flow on a monthly or quarterly basis? So what are your thoughts?
Yeah, Kevin, maybe I'll let you tackle that from the accounting standpoint, and then I can hop in on the investment piece there.
Yeah, I mean, I think It definitely does. If there's an uncertainty related to future revenue, being able to project cash flows also becomes very uncertain. That being said, if historically the industry that the company's in operates this way year in and year out, and the company has done consistently 10 to 15 million each year, I think from a budgeting and cash flow perspective, if contacts with customers and prospects remain consistent year over year, from a budgeting perspective, I think it probably makes sense to include some of those unknown revenues in a forecast. And I say that only because, or I say that assuming that the company has historically operated in a similar way. Contracts are shorter in nature, future ones are unknown, but historically the company has delivered. And I mean, man, back to 2020, this could have definitely complicated things. But if the years are normal, quote unquote, and normal now is different than normal last year, but if a year is normal and the company doesn't foresee a reason that the next year would be different, I think forecasting some of those uncertainties and maybe discounting it by a certain percentage does make sense. Because, like I said, if the company has been operating that way historically, and there's reason to believe that they will operate that way in the future, I think it's a more realistic budget.
And I just quickly say, from my perspective there, that kind of can go back to ownership's tolerance of risk and how they feel about use of leverage, right? I think with the rate environment being this low, we see some companies willing to borrow more and keep cash working for them in other areas. Other companies are very conservative, and they really don't care that rates are so low. They don't want to use leverage. So, that's another component to this. But certainly it's challenging when you have shorter contracts. So, I think we typically see a mixed bag in terms of who utilizes an investment policy statement. And sure enough, I mean, looking at these results, pretty much what we see often, kind of 50-50 range. And, I think for those of you that do have an IPS in place, let's think of yours and compare here. And for those that don't, I have a few items that I'll quickly run through that may be important to consider if you develop one. Also, we'll be diving into kind of the benefits of doing this. So you go through all this effort to put, together this really good, robust statement. You really want to understand what the overall economic value of it will be over time, and we'll talk about that. So what does the investment policy statement look like, and what are the tangibles here? Many of you may be familiar with this as it relates to, your employer plan. This is very similar to that process. It's really all about segmenting by time horizon. And going back to that graph we described earlier that breaks out your three buckets. Segmenting into those buckets, the short, intermediate, and long term, and getting tight on the risk level of each bucket. And the thing with risk is you can really control a lot of the bandwidth of risk over longer time periods. You fully recognize the risk you want to take, you outline it. Of course, the investments are going to ebb and flow over time, but you can effectively monitor that risk and readjust. And also, I want to highlight that we're not just talking about market risk or the risk that I bought something in late January this year and it went down due to COVID. We're also talking about more prevalent longer-term risks like interest rate risk, inflation risk, default risk. Am I going to get paid back? Liquidity risk, specific company risk. So you gotta want to look at all risks, not just the shorter-term market swings. Also, improving your cash flow and increasing your tax efficiency are outcomes of this, and we'll talk about that in a second here. As far as assessing underlying risk, just a couple things I'll go over broadly. The first is credit quality and kind of the public debt markets. You only want to invest in investment-grade securities, and there are a host of rating agencies that can help with that. Position sizing, don't get too excited about any one position. 5% is generally the maximum we'd recommend having in any one position. So you want 20 to 25 holdings at minimum. Diversification, all of those tenets of diversification apply, and that would include position size, geography, type of bond or other security. And then finally, laddering. And I think this is really important right now in this rate environment. You want to spread out your fixed income maturities over, various time periods to help fight interest rate risk. Want to be very mindful of not going too long in this in this environment. So tax efficiency. It's great to bring this process to a tax planning meeting, and specifically I'd say there's 3 areas you want to focus on. The biggest piece is probably the allocation between tax-free and taxable income, and I think California is a great example. California municipal bonds continue to be in high demand to eliminate state and federal taxes, even in this low rate environment. And other times you're going to want to, look at more attractive yields with taxable bonds at different maturities. So I think it's really critical to look at the tax equivalent yield on both when constructing a kind of a fixed income ladder. Capital gains management, right now, there are a ton of embedded gains in fixed income due to the reduction of interest rates over time. So evaluating, should I take those gains now? Am I an S or a C corp? Do the gains flow through to my owners? And that's critical to look at. And then lastly, being mindful of AMT tax with those flow-through entities, specifically any investments in private activity bonds as they are subject to this. You want to be careful when buying those. One of the biggest pieces of putting this all together is improving your process over time. It provides us with a historical record and allows us to monitor and improve upon. And I would say you want to keep this really simple from a benchmarking standpoint. What did I put in? What did it generate for me, both in terms of capital appreciation and income? What did it cost me in total? And that includes transactional costs and any ongoing fees. And then what was my net result in percentage and total dollars? And how does that relate to an appropriate benchmark over time? I really think it's critical to keep it that simple. And I know sometimes that can be challenging depending on the brokerage statements that you may get, but want to break it down into that simple formula. So kind of going through that 5-step process, and refining your investment policy statement, I think can really help you to restructure some of your existing liquidity and improve the decision-making process within your treasury function. And I think that really can create a competitive advantage for your business over time. And with that, I will turn it over to Eric now to discuss some cash KPIs.
Great. Thank you, Aaron. Welcome, everyone. My name is Eric Newton, and we're going to be talking about cash KPIs and things that you should be monitoring around cash. So quickly, what we're going to be covering, the current situation around cash for contractors, attributes of a contractor with an innovative back office system, key KPIs for cash in construction, how to manage your WIP for cash. I'm going to hit a few other metrics that contractors should be watching, and hopefully we'll have a few minutes at the end for some more questions, so please keep putting questions in. For the last 10 years, construction has been a fast-growing but risky industry to be in. Contractors have always had to deal with tight margins, project delivery delays, labor shortages, and now we have COVID-19, which continues to go on and on. Contractors had issues with managing cash flow even before COVID hit us, but now it's gotten even worse. Contractors are really scrambling now to build an accurate statement of cash flows and forecast cash into the future. But they're finding that they have many barriers to accurate cash flow forecasting. They can't look at cash management the way they always have. Now they have to adopt a multidimensional approach to forecasting to gain a comprehensive view and insights that they need. Contractors need to be watching key KPIs like margin paid, job borrow, and days of cash on hand, and they need to be doing this daily or weekly, not just monthly or quarterly. I even saw in some of the comments that some of the contractors on this webinar are watching their cash every day. So it's not just a quarterly, or annually event. Every contractor has a WIP report. They also need to be watching that closely for underbillings to see which jobs are using their cash. And the WIP report needs to be flexible and viewable over time to give better analysis. The challenge is having access to this data in a fast and easy way to make quick decisions. Many contractors are having to pull the data from multiple systems, and that is complicated and time-consuming. Today, many environments look like this. Data resides in multiple systems. The accounting system holds the majority of the data, especially around cost and billings. The project management and the scheduling solutions have the cost to complete and the time frames required. The CRM solutions have the pipelines of jobs coming up to bid. The estimating solutions have the jobs currently being bid but not yet awarded. So to accurately forecast, contractors have to pull data from all these systems and then combine and coordinate it with multiple individuals within their company to get the information they need. Then they have to put it into a large spreadsheet with lots of formulas that can easily get corrupted and deal with version control and emailing it back and forth. It's inefficient, cumbersome, and error-prone. Maybe some of the contractors on this webinar have experienced similar issues. When you're trying to forecast cash quickly, you don't have time to deal with these types of problems. So we're going to ask another polling question real quick. So Amy, I'm going to turn it back over to you to ask this question.
All right, thank you, Eric. So our third polling question is, what do you currently use for budgeting, consolidations, and reporting? A, ERP system, B, Excel, C, CPM solutions, D, other, or E, I don't know, or NA. And for those of you that would like a copy of today's slides, you can download them from the folder that says slide deck and handouts. We will also be sending the slides via email tomorrow, along with a recording of this webcast.
So Eric, while we're waiting for the results, I know that you worked prior to being at Prophix. You actually worked for a construction company, so you've had real, live hands-on experience. I'm curious, what did you find to be probably the biggest challenge when you were trying to forecast your cash?
Yeah, that's a great question. Thank you, Elaine. Yeah, I was a CFO for a contractor for 10 years and public accounting for 6 years before I got on the technology side. And I used to meet every week with our chief estimator and our head of operations, and we would go over our job cost reports, and we would look at budget versus actuals and really focus in on the jobs from a profitability perspective. What I didn't do was meet with them around cash forecasting, and that was a mistake because I was trying to do the cash forecasting on my own from a financial perspective. So I was looking at things like, what is the average days to pay by customer and factoring that in, and kind of what our payment terms were on the AP side, and other things like how we were doing on our line of credit and capital purchase. So I was really looking at it from an accounting perspective. I was not looking at it from an operational perspective. So a lot of times I thought that some of the receivables were going to be coming in, and because of the payment terms we have with the customer, and they didn't because there was an issue on the job. Had I been meeting with the operations side, they would have told me, there's an issue on this job, this customer's upset, they're not going to be paying right now. So I think that type of communication, so when you're working with your estimating and field departments, talk about cash as well, don't just talk about profitability. Did that answer your question?
Yes, it does. Thank you for that. Yeah, that was great insight. Thank you.
All right, great. All right, and these results are up now. So 25% of the webinar attendees are doing this through their ERP, 55% through Excel, which I expected to see. 2% are using a CPM. If you're not familiar with CPM, that's Corporate Performance Management Solutions, and 11% are others. So these are pretty typical results. We see a lot of people trying to do this through Excel, so hopefully the things I was just talking about they can relate to, and we'll hopefully show them some new ways to do things a little bit faster and better today. So let's talk a little bit about innovating your back office system. If you want to innovate your back office, here are some of the key attributes you should be considering. You should have constant access to key information about your business, as Kevin and Aaron said earlier. You should know key industry ratios and how they apply to your business. You should be focusing on important items like cash and cash forecasting. Be able to analyze your WIP report in lots of different ways. Be able to manage your G&A and overhead expenses and keep them in line with revenues and margins. You should also be monitoring resources like employees and equipment to make sure they're being properly utilized. And then you constantly, of course, have to watch the profitability of your company. All of this needs to be able to be done quickly to adjust to changing conditions that contractors always experience, but especially in the year that we've been through this year. Now I want to get a little bit more focused on cash. CFMA, Construction Financial Management Association, puts out a benchmarking tool every year that allows contractors to benchmark or compare themselves to other contractors to see how they stack up. I know Moss Adams puts out one as well. But I pulled the results from CFMA a few weeks ago to see what the average days of cash a contractor had on hand. I was a little surprised to see how close the days of cash on hand were across all sizes of contractors. It ranged from 21.2 days to 52 days, with surprisingly the smallest contractors having the most days of cash on hand. The median days of cash on hand by contractor size was 27, and this survey was done before COVID hit. So it was 27 last year. And then if you look at it from a vertical perspective, this is the same data, but looking at it from a vertical perspective, which I think contractors should really look at, contractors in the same vertical that they're in. Notice how the median days of cash changes when you view the ratio this way. The median goes down to 21.4, and the range goes from 16.3 to 27 days. What this indicates is that the size of contractors has more to do with the days of cash than the vertical they are in. So I believe the best way to benchmark against peers is to look at contractors in similar verticals of the same size. And then as you improve, look at the best of class contractors in your category as well. Now I want to go over a few KPIs, key performance indicators, that I used when I was a CFO for a contractor and in public accounting working with contractors. These are KPIs that are more focused on cash and liquidity, and they should be monitored regularly to spot trends and make sure your company is staying financially healthy. The days of cash KPI that we were just talking about, this is the number of days in revenue you have available in cash. A contractor under normal circumstances should have at least 20 days of cash on hand. I would recommend a lot more than that, but at least 20 days. And in today's difficult circumstances, they need to be doing other things like drawing down on the line of credit, typical cash saving strategies like better collections, delaying payments to vendors, faster billing, all things to help drive up the cash balance before it's too late. Another good ratio to look at is the cash as a percent of equity and revenue KPI. This is how much of your equity you have tied up in cash to fund your daily operations and how much cash you have to drive your revenue. If you always keep the same amount in cash, but revenue and the related costs are rising, then you need to be putting aside more cash to fund operations. Needless to say, it takes more cash to run a $30 million construction operation than it does to run a $10 million construction business, especially if you self-perform and have to make weekly payroll. It's common sense, but a lot of contractors don't stop to think about it. The owner of my construction company always had a number in mind that he thought we should have in cash, even as we grew. And so sometimes we had issues with cash because he had that number in his head. So just recognize as you grow, your need for cash grows as well. And then, do you have a line of credit to help you fund down times? And if so, how much do you have available on it? You should be tracking this all the time. If it's maxed out already and you only have 20 days of cash on hand, then you're going to have a problem with cash flow. As Aaron and Kevin talked about, many of the banks are really tightening up credit right now, so it's more important than ever to be working with a bank that understands construction and the cycles that we go through in this industry. Here's a couple of more KPIs for cash. One thing I learned long ago in construction accounting is that underbillings are bad and overbillings are good. This is as basic in construction accounting as debits equals credits or assets equals liabilities plus equity. This was something I had to drill in my head when I got into construction accounting. Contractors are always going to have jobs with underbillings, which just means you have recognized more earned revenue on the job than you bill the customer for, but that should be the exception and not the norm, and each job with underbillings needs to be scrutinized. If you get too high of a percentage of underbillings in relation to your equity, the sureties and the banks are going to question your real profitability and how well you're running your company. A ratio in excess of 10% is considered unusual by most sureties. A ratio of greater than 20% on underbillings to working capital is also considered high by sureties. So if you start hitting ratios higher than this on underbillings, the sureties and the banks are really going to look at your credit worthiness. Another one to look at is the cash to overbillings. This one should always exceed a ratio of 1. If you think about it, if you have overbilled unless it's still sitting in receivables, you have not incurred the cost yet, and you will therefore need this cash in the future to fund your job. So while we normally think of overbillings as good, you need to watch this ratio to make sure it stays in line as well. And then cash flow from contracts. This represents the amount of gross profit which has been collected. This is calculated by deducting job receivables and underbillings from gross profit and adding back payables and overbillings. Basically, this ratio makes sure you're collecting on the profits that your company has generated. So this is another good ratio that contractors should be watching. And then the net of current receivables and payables KPI. This is an indicator of how a contractor is managing their cash flow as well. An unusually low number can indicate that a contractor has experienced or is about to experience cash flow problems. You should also be watching your retainages. They should be broken out and tracked separately when you're doing your ratios. Most of the construction ERPs handle this very well. And of course, the contractors should be looking at the standard liquidity ratios, the current ratio, the quick ratio, and then one some contractors may not have heard of is the high liquidity ratio. Right now, I think that is the most important one. And the high liquidity ratio is assets that can be liquidated within 30 days versus payables due on demand or within 30 days. So if that's not one you're tracking right now, I'd highly recommend that one. We learned about the current ratio and the quick ratio in college, but we did not really hear much about the high liquidity ratio. So right now, I'd especially be watching that one. And then, are you watching cash flow by project manager or job? This is really important. It's not only important to know if a job is profitable, but you need to know how the PMs are doing managing cash across all their jobs. So this KPI gives a quick summary of how each project manager is doing on a weekly basis. You want to watch this dashboard over time to determine which PMs are the best at billing and generating cash for the company. And then from the dashboard, you want to be able to drill down into a report to get more detail. On this report, you can see how the PMs are doing against their forecasts on a weekly basis and by job. So you can quickly see which PMs are good at forecasting cash and how much cash each job is using on a weekly basis. Many contractors only evaluate their PMs on how well they get the job done and how profitable it is. But you also have to be able to cash flow the jobs as well. So a report like this will help you in getting the PMs aligned to help the company stay afloat during difficult times by having them focus on cash. Now we're going to do another polling question. So Amy, if you want to kick this one off.
All right, thank you, Eric. So our last polling question is, what do you think will be the biggest disruption to the industry post-COVID? A, workforce and staffing needs, B, maintaining cash reserves, C, safety issues, or D, government regulations. And once you've completed all CPE requirements, you will be able to download a PDF of your certificate from the CPE Progress window. And if you attended today's presentation in a group and would like to receive credit, you must complete the group attendance sheet found in the console.
So Eric, we do have a question that came in, and it is one of the biggest issues that I have that makes projections difficult, is that getting a notice to proceed can slip for a number of reasons. Rarely do they happen early, but once in a while it does. Since our projects are large, any schedule differences change my results significantly. Any words of wisdom on how to better predict when the projects start?
Yeah, I think that goes back to the communication with the operations side of the company. So a lot of times they will know if something is holding up those notice to proceed in advance of the finance team. So I would think just communicating with them, communicating better with the customers, maybe setting up some formal processes to make those notifications more automatic. Things like that I think would help in that situation. All right, we should have all the, well, Amy, you clicked it too. There we go. So this is not surprising to me. The biggest disruption post-COVID, this was the kind of the issue before COVID, and I think it continues to be an issue. It's the workforce and staffing needs. So contractors are really watching that, maintaining cash reserves. I'm glad to see, I guess, that is important to you. You think it's important in the future, and that's probably why you're attending this webinar. Safety issues at 16%, so a lot of people are concerned about that. And then a lot of people concerned about government regulations. Pretty evenly split, but most people are dealing with the workforce and staffing needs like we had even before COVID. So interesting. Thanks for the feedback. All right, so we've been talking a lot about historical data with KPIs, but I'd like to talk a little bit about cash forecasting. Here's an example of a weekly cash flow forecast that could be used by a project manager. It is basically pulling accounts receivable and payable information by job and project manager, showing the PM the amount outstanding in AR and AP for each job. They can then help the accounting department forecast when the billings will be collected, and also maybe give input on when payables need to be paid. Then this information would flow into an overall master cash forecast that would include other items. The master forecast would look something like this, and it would take into account things like payroll, notes payments, lease payments, overhead expenses, line of credit, advances or payments, etc. This data would typically come in from the ERP, and then you should be able to take this data and forecast using historical information and maybe adjust it based on factors like, what if I cut my overhead 10%? How would that impact my cash position in the future? What if I cut my payroll costs by 5%? How would that impact cash? By being able to forecast this way, you can anticipate what you need to do now to stay in compliance with your line of credit restrictions and to make sure you have enough cash in the future. So hopefully those are a couple of good examples that people can use around cash forecasting. Now I want to switch a little bit to WIP reporting. I know we're getting close to our time, so I want to hit a little bit on WIP. As I said earlier, many people, all contractors have a WIP and they're looking at it, but they tend to look at it in one way. So that they have a standard WIP report and job number order. Maybe it has the active jobs at the top and the closed jobs at the bottom. But they need to be able to look at it in a lot of different ways. Here's an example of one at the top that's more standard and it's got fade on it. And then we have one by customer in here. So you can see what the backlog is by customer and profitability by customer. Maybe you add aging data on it as well. And then a WIP by project manager is good to show how profitable the project managers are, if they have over or under billings on there. And then you might want to have one by estimator. Having a WIP report by estimator is a good way. So a lot of different ways you want to be able to look at it. And in light of COVID, how about a WIP report by state or city with all the shutdowns going on? So contractors, if they can have their WIP in a lot of different ways, they can analyze it and really use it to help drive cash a lot better. It's not really so much about where you have the contracts right now. It's about which contracts you can work on and which customers are going to be able to pay you. So it's important to be able to look at that WIP in a lot of different ways. You may think you have a lot more in backlog than you really do. And then KPIs for G&A expense. All contractors should be watching their backlog to make sure they're growing to drive revenue growth, or if it's falling, making appropriate cost-cutting measures now to align to the new measures of work. So you need to be looking at the backlog in a lot of different ways. As I said a second ago, you could have work on the book, meaning valid contracts, but if that work is halted or your chance of collection is low, then you've reduced your backlog significantly, and you're going to need to cut costs, especially probably around G&A expenses. So you need to be able to look at each job and assess your likelihood of the job continuing or not and adjusting accordingly. and it's also time to reassess the credit worthiness of all your customers. So how much profit do you have in your remaining backlog? Have you adjusted your estimated cost to complete for the effects of COVID? None of the estimators estimated the cost of COVID when they bid jobs 2 or 3 years ago. And then is the profits that you have in there enough to cover G&A expenses? Typically, the backlog gross profit should exceed 50% of your G&A expenses if you want to turn a profit. And then a few other things to be looking at. Regardless of what disruption or difficulty comes, we can be sure something is going to happen in 2021. That's why it's important to have key financial and operational information at your fingertips. Corporate performance management solutions allow you to have all these KPIs on one dashboard with the ability to act on that information from the dashboard. That's the main difference between a CPM solution and a BI solution. You can not only drill down into the detail with a CPM solution, but you can take action on it and do what-if scenarios off of it. So I covered a lot of KPIs specific to cash, but you should also be looking at other metrics right now: job margin by job, average labor rate to help you forecast cost reduction measures, margin fade for the current month to let you quickly spot issues with jobs that are having profit fade, margin by customers to determine the customers you're making the most or least profit on, billings by project manager to know if they're keeping their billings up to date, and then 12-month gross margin. So with that, I'm going to turn it back over to you, Elaine, to wrap up because I know we're about out of time.
All right. Well, this is Amy. I'll close this out. So here is the contact information for our speakers, and their information is also in your console. If you would like to use any of that, feel free. And if we didn't have time to answer your questions, we will do our best to follow up with you after the webcast. And I just want to thank Kevin, Aaron, and Eric for a great presentation today. And I will keep the webcast console open for a few minutes to give you time to download your CPE certificate. A copy will be emailed within 3 weeks should you have any difficulty downloading it now. And here is a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey as your feedback is very important to us. Thank you for joining our webcast. We hope you'll join us again next time.